MCX IPF and CNBC TV18 present The Commodity Classroom, Energy Price Risk Management, an Effective Sustainability Mechanism.
A very warm welcome to all of you in Commodity Classroom, which is presented to you by MCX IPF and CNBC TV18. The theme of conversation is about crude oil, and we're going to talk about energy price risk management and effective sustainability mechanism here. We are going to talk about this volatility in the event today. We'll be talking about on how do you deal with this competing, challenging environment. What are the best ways of price risk management, and how do you manage these risks basically going forward? When we talk about the crude oil prices, almost all of us are exposed to it in some way or the other, whether it's about aviation, travel, logistics, LPG. We've seen those prices gain up, by the way, fuel. So what is the best way? What are the instruments available to deal with this is what we will be talking about, and in the best possible ways as well. So without further ado, let me invite on stage Ms. Ruchi Shukla. She's Head Energy MCX, and we'll talk about various instruments that are there and how do you deal with that. Ruchi.
So we have all gathered. She has already set the stage with the crude oil volatility. Yes, the prices are here to stay, volatility is here to stay, but how do we manage it well so that we can survive and sustain ourselves? Commodity derivatives is a very, very effective instrument which is utilized globally for risk management in all the commodities and specifically for energy price risk management. There's a SEBI regulated exchanges existing in Indian markets under stringent regulatory norms. So they are under stringent surveillance norms as well. So why not take the benefit of these exchanges and manage our risk, and then manage your risk and focus on your business margins. So that's the way to go ahead. So what is the proposition which the exchange traded derivatives bring to market? First is transparency. All these exchanges, as I said, are under the regulations of the regulator SEBI. They provide only a completely transparent platform with anonymous trades happening over there. Secondly, liquidity. Liquidity in energy markets. The truth is, right now in Indian markets, the energy products, both crude oil and natural gas derivatives exist, which are highly liquid products. So liquidity, what brings is easy entry and easy exit. What do we do if we talk of, say, entering into, say, long-term physical contracts or PPAs, but you get fixed into it? You cannot, it's not anytime entry, anytime exit in that. But derivatives give you that space, and they are highly liquid enough for your easy entry exit. Then the third most important thing comes is novation. That is a counterparty guarantee. So if you are entering into a physical contract, a forward contract, it's not standardized, plus you have to do due diligence of your counterparty. But here, the clearing corporations provide you the counterparty guarantee. So there is novation available, which is the best part of managing your risk on the exchange traded platforms. So these are the benefits which the exchanges bring in. So how do you utilize this? The exchange traded one is risk management mechanism. Every corporate going ahead needs to manage the risk of the input. We will see in the further slides and the further discussion how every kind of an industry, you name the industry, it is directly or indirectly linked to either crude oil or natural gas prices. So anyways, we need to manage that risk. Then on the other side, it's also because in any market, you can't have a market with only, say, hedgers on one side. We have a collection, different types of participants. So it's also portfolio diversification. And it's globally proven that the commodities in your portfolio provide you a natural inflation hedge. So as an investor, financial investor as well, diversifying your portfolio to commodities definitely provides you an inflation hedge over there. What are the benefits specifically? If you see what are the benefits you're getting in energy products, crude oil and natural gas. Now in crude oil, you almost import 90% of our crude oil. On natural gas side, LNG, we are nearly 60% importers. But how do we hedge? Do we need to go abroad to the exchanges? No. We have those markets, those products available in India with the international linkage underlyings, and you don't have to manage a forex risk because these are rupee denominated contracts. They are converted back from that underlying dollar based underlying to rupee at RBI reference rate. So forex risk is naturally taken care of. That's a premium advantage which you get, plus these are cash settled products. So purely from the risk management perspective, are very good products available in Indian markets. Whenever we consider hedging, we have to take into account the spot plus minus derivatives. Spot plus or minus derivatives is going to maintain sometimes you may have profits in spot market, so you'll have losses in derivatives, but they'll be set off. Again, you can have losses in physical market if the prices of the spot are high, but you'll have profits in derivatives to offset those losses. That is what pure hedging is. Now, there can be two linkages. Now, when you are purchasing your fuel, yes, there can be a direct linkage. You're invoicing directly, it can be crude. But there are also, you may have indirect linkage to crude and natural gas through the crude oil byproducts. So, be it furnace oil, naphtha, ATF, anywhere and see the list of company, any industry, you name any industry, take it crude oil refiners, glass, forging, steel, textile, transportation, our airlines, name it, and it is there on the board. They are all exposed to the vagaries of energy prices, and the correlation with the crude oil, it's almost besides the benzene, everything is above 90. So anywhere above, if 80 to 85% above correlation, definitely can make a good hedge ratio. So this is called indirect hedging, but yes, still that kind of a product is available for you to hedge in the markets. Thank you so much. So leaving you with the thought, don't worry about where the prices are going, don't focus. Let's focus on our industry, on our business, let's maintain the margins. Thank you so much.
MCX IPF and CNBC TV18 present the Commodity Classroom, Energy Price Risk Management and Effective Sustainability Mechanism. MCX IPF and CNBC TV18 present the Commodity Classroom, Energy Price Risk Management and Effective Sustainability Mechanism.
I will call on stage now back Ruchi Shukla, who's head Energy MCX. I also invite Ms. Meenakshi Agarwal. She is DGM International Trade, Indian Oil Corporation Limited. Also calling on stage Amardev Singh. He is Senior VP Research at Angel One Limited. And finally, Muzammil Patel is Head Strategy. He's Corporate Finance and Operations at ACES. We hope that this discussion is enriching for you all. We will start with a small panel discussion. Starting, Ruchi, right back first from you. And with the kind of volatility that we have seen in the space, what's your sense? What would you advise stakeholders to ensure that they are part of this and then that their profitability is saved as well?
So when we talk of volatility, so always it is said, whatever is under our control, we should look at it. Which is not, we cannot really do anything about it. But here there is an uncontrollable factor, volatility and uncontrollable factor, but we can surely do something about it. So what we can do is, yes, hedge our price risk, try and understand what are the best practices. One is, yes, pass-through mechanism, which I said, it's not going to operate you in the long run. The next is, we can enter into forward contracts, but they carry their cons. They will exist in the market definitely, but they carry their cons as well. And then come the derivative, purely a transparent instrument, the derivative instruments. And under derivatives right now, as Manisha already, we have futures, we have options. And now recently with the SEBI circular in allowing multiple variants, we have mini contracts available in Indian markets, which definitely will cater to different kind of a participant. Now, since we are talking more on risk management, with the introduction of mini contracts, definitely our smaller companies, SMEs and MSMEs, these who could who cannot go abroad, like they cannot always go abroad on CME platforms because again that carries a lot of cost in. But these smaller contracts are very beneficial. If I talk of a small SME, generally it's 10 barrels to 20 barrels of a consumption of crude oil on a monthly basis. So that's kind of a mini contract available in India with 10 barrels lot size, and with at the current prices, if you see with a smaller margin of 18 to 20%, if you can hedge your risk, a larger risk, and sustain and survive your companies, it's a huge benefit. On the other hand, we have, yes, the main contracts, futures and options for the larger corporates to come into play. They can also manage their risk to those contracts, and the participation on the other side, all the arbitragers, the traders, the financial investors, they are there to take on that risk. The markets are liquid enough.
What are the fundamentals, Amar, that you look for in the crude oil prices right now? I mean, there's plenty, but as we move ahead from here for the rest of 2023, where do you have your eyes on?
So what we see is that currently, if you look at the demand-supply scenario, that's more or less evenly poised. So somewhere we are seeing 100 million barrels production is there. Demand is also almost around the same level. So it's more or less balanced. The major worry wherein crude prices had gone up to 130 was supply disruption. So, but Russia managed and manages to produce crude oil. So if you look at the way it is producing almost 11 million barrels, it's still able to produce. So clearly that shows that the crude oil which Russia is producing is being to a very great extent being consumed by India and China, because they are getting at relatively very cheap rates, sub $60. So that's a big add-on which is really benefiting. So that's one of the factor which plays. So geopolitical tensions. The second is OPEC. If we look at OPEC produces around 34% of the total crude oil. And there if some issue happens, because there again Saudi Arabia is a major player, produces almost 12 million barrels per day. Then we have the United States, close to 12 million barrels a day. Then we've got Russia. So OPEC is again an important player, how the stability is there in that region. So that's one factor. Apart from that, there is supply disruption. So if supply disruptions happens, so we had one recent event where the Suez Canal, there was a major tanker that was blocked. So supply, because it's all about the supply network and supply chain. So how that's playing out, that's again something which is very important. And then I would say the hurricane season also plays an important role during the, I would say, when we have in the US. So that has an important role there. And apart from that, the US dollar, because all these are dollar denominated currencies, so they have an impact there. So these are some key factors which play upon crude oil.
So there's a long list, by the way. You mentioned almost 10 to 12 of them. If I had to ask you on top 3 fundamentals that the markets should watch out for, what would those be?
I would say one is that you have to look at the supply balance, demand-supply balance. That's something very important. Also, if you look at relatively the OPEC surplus capacity, so if you look at a 10-year period surplus capacity, that was around 2.7 million barrels, which is currently around 3.18 million barrels. So clearly shows that the supply side is well placed. So, and the demand also, the latest IMF report which has come in, that says that the demand means the world economy is expected to grow by 2.9% in 2023. Then it will bounce back to 3.1 in 2024. So it would be more a factor of global economy, how the global economy plays out. That's one major factor, and the demand supply balance. So these are a couple of factors you have to look at.
Meenakshi, let's come to you then. And you are a stakeholder clearly, and with the kind of volatility that we are all predicting here and the uncertainty that we are looking at, how you as a company, as the largest refiner in the country, when you look at the inventory prices, what is your sense? How would you manage your risk going forward with this kind of a volatility?
I think inventories definitely is a very, very complex subject because in any manufacturing plant, not just in a refinery, there are all kinds of inventories that are there, be it raw material, then during the process, intermediate, and then the finished product inventory. So I wouldn't say that any business would look only at inventory separately. For a business, what is important is your bottom line, the entire process. While all hedging and all risks are they have been mentioned. But I would say to understand really what is the exposure for your company is the first step in devising the hedging strategy. Hedging strategies have to be very, very carefully and cautiously laid out and understood by the people who are managing the businesses. Because, yes, through risk management, it is possible to hedge, it is possible to fix the price, but fix the price in such a way that it doesn't kind of, put your company in a risk when the prices go in different direction. So it's important to understand all those risks. It's important to understand the limitations of the solutions as well. But with full understanding, when cautiously all steps are taken, it proves out to be a very good mechanism. All the hedging strategies have to be prepared considering what you consider as a short-term risk and a long-term risk. So considering that, all those plans are drawn up. But definitely when businesses look out for, whether we should hold additional inventories or not, they look at the forward curves, which are given by the derivatives market, to see whether the curve is supporting their decisions for additional storage or not. Because when we are talking about additional inventories, having incremental inventories, there is a need for additional storage. There is additional cost that we are going to incur. So whether benefit is going to come or not, so there is no certainty if we leave them open. But whether the forward curve is supporting that decision or not, that has to be constantly monitored.
Meenakshi, how would you say that the landscape has changed maybe in last 5 or 10 years for IOC as a company? I mean, we are importing more and more, as everybody is saying here. Our dependence is 90% right now, which perhaps could go higher as well. We are importing more from Russia right now. So with what is happening, what do you think has changed in 10 years? Is there more hedging opportunities? Would you advise corporates to hedge more for the...
Hedging, I would say it's important to understand the risk and it's important to understand the solutions. Sometimes hedging is important beyond your comfortable limit. Also, you can cross sometimes, but sometimes not hedging is also a good strategy because it's important to look at your exposure. So if you feel that your exposure is, like for example, I'll just give you a simple example. Suppose in a company there are two departments. One is a purchase department, the other one is a sales department. But for purchase department, they will say crude oil price, if the cost for crude oil goes up, my cost goes up. But if the sales department says my sales also go up, there's a net position that we have to look at. So netting of that exposure is important. Therefore, I'm saying the entire process of business, the entire bottom line has to be checked before taking any business decisions.
But Muzammil, this one is to you then. And there is just so much that goes in when you're taking a hedging decision as well. Do help us with some case studies. If I was a stakeholder, if I was an investor, and if I was hedging the underlying commodity because I was holding on a stock.
It's important to understand, and you made a very valid point there. If I'm investing in IOC or if I'm investing in an oil refiner, am I investing in oil, right? No, you're not. What you're investing in when you invest in a refiner is the margin that the refiner produces, right? However, if you were investing in a crude oil exploration company, you're perhaps investing in oil. So you have bought into the risk of crude oil or any commodity for that matter if you bought into an explorer. But when you bought into a refiner, what you want to make sure, and any processor of any commodity, is that the margin that they give on processing that commodity, that stays consistent quarter after quarter after quarter. And therefore, for processors more than producers or explorers of any commodity, it's extremely important to have a structured hedging program where the pricing in and the pricing out, that's essentially the gap that they're trying to manage and the timing that they're trying to manage, is nullified out, and the margin in that business by design is a lot lesser. Now, when you come further down that value chain to the consumers, right, there are two questions that a consumer of any commodity has to ask. Can I pass this price on to the end consumer who's going to buy the commodity, and when can I pass it on, right? Theoretically, yes, you can pass on every price at some point to the end consumer, but until you can't, you have to be able to lock in or hold that price so that you sustain that business model. Because the choice you have is take a hit on margins now and hope that at a later point of time when input prices go down, I'll make that margin up later. But again, that's just playing the volatility, right? And therefore, for a consumer, the hedging program may be reasonably short term depending on how stable your margin is.
How would you look at and what sense would you give to people who are investors in any asset classes on how should they be dealing with crude oil in sense of hedging, perhaps investing, or even trading?
Pretty much every commodity other than, let's say, bullion, right, is essentially not necessarily something you're investing in for 15 years or 20 years. It's not equity, right? I think it's fundamentally important to understand that. You look at crude oil, we've seen it, all the way from, negative at one point of time, 230. And that cycle's repeated itself over and over. It's not new. This is not the first time we've seen that. And therefore, it's important to understand that the whole point of playing in the commodity cycle is either you are a physical player who is essentially adding value to that cycle, or you are an investor who understands that cycle, right, and is therefore investing to protect or finance that cycle. So for example, with most commodities, you're better off financing the value chain than you are necessarily in speculating on the commodity itself. And I think that's important to understand, except bullion aside, that's an important thing to understand with virtually any commodity.
Absolutely. And Ruchi, that brings me to you really, because there are so many various instruments within that commodity. And SEBI clearly has allowed that. You can trade so many mini, major options, indices, etc. How have you seen the participation within that? And would you say that people now, investors for that matter, have been able to make use of that? I mean, of course, we've seen great volumes happen in India.
Yes. Gradually, as SEBI picked up as a regulator, the basic product which was permitted was futures in Indian markets, because that's a easier product to understand than options. So futures were allowed. So as the markets really picked up and understood, because commodity derivatives in itself is quite different from equity derivatives. So understanding how the panel has already discussed the fundamentals which are playing into this, the track of the elements, the value elements which you need to track each day are quite different. So understanding of these products was quite different. So futures were allowed. Gradually options have been allowed in this market. Different products have been added, different market participants have been added. Gradually over a period we have seen wherein only larger players, maybe larger algo traders or investors were participating. They've come down to the retail participation we are seeing. SEBI as a regulator has been very, very supportive in developing the markets, because in a span of around say 7-8 years, allowing so many products, then allowing different institutional participants, now we have come to the stage where mutual funds and FPIs are also allowed. But now is the time. Corporates have been approaching us. Yes, we want to understand how we can better manage, what kind of a hedge policy we can design for a company, how we can actually convince our board or management, yes, risk management is now the need of the hour. So we are seeing a better market, so let's all actually live our lives with hedge in our lives so we can peacefully sleep and our industry, our India can grow.
All right. I think with that, we've come to an end of this commodity classroom. Really thank the audience here. You've been very enthusiastic and a lovely demeanor. It's great seeing you here. Thank you so much for that. And thank you so much, panelists, for being here.
MCX IPF and CNBC TV18 present the Commodity Classroom, Energy Price Risk Management, and Effective Sustainability Mechanism.